Treasury has projected wider budget deficits and higher debt over the next 3 years. That's as a result of lower revenue collection and comes despite expectations for better growth due to improved electricity supply. Presenting the medium-term budget policy statement, Finance Minister Enoch Godongwana projected a consolidated deficit at 5% of GDP in the fiscal year that ends in March 2025. That's wider than the 4.5% deficit forecast in February. The gross tax revenue estimate for the 2024-25 fiscal year has been revised down by 22.3 billion rand due to a decline in the fuel levy and import value-added tax collections.
Over the next 2 years, the main budget revenue has also been lowered by 30.2 billion. In the absence of faster growth and in the face of external risk, tax revenue will remain under pressure, forcing us to make difficult decisions on where to spend. Lower revenue also means that we cannot, and within the envelope, accommodate all the demands of the fiscus. Difficult trade-offs in all spheres of government will have to be made.
South Africa's gross debt is now seen stabilizing at 75.5% of GDP in 2025-26.
We know that our debt is unsustainable because debt service costs have become the largest component of our spending, and it is rising faster than economic growth. Debt service costs will reach 388.9 billion rand in the current financial year. Put differently, this means for every 1 rand of revenue that government raises this year, 22 cents of this is paid in debt service cost. To deal with this problem, we have taken difficult steps to reduce the budget deficit.
The economy is expected to expand 1.1% this year. That's down from a February estimate of 1.3%. In 2025, the economy is expected to expand 1.7%. In company news, Glencore has reported lower metals output for the first 9 months. That's as production shrank for copper, cobalt, zinc, nickel and thermal coal. But the miner and trader has reiterated that it expects its trading profit to reach the high end of its long-term range. That puts the metric at up to $3.5 billion. Impala Platinum has posted lower output during the miner's first quarter. Production volumes fell 5% during the period. That's due to guided changes in operational parameters at several of the group's assets, and it also reflects the effect of furnace commissioning at Zimplats. Despite the first quarter challenges, Implats has maintained its guidance for volumes, cost and capital expenditure for the full year. Tiger Brands is expecting a profit rise. South Africa's biggest food company has forecast an increase of between 3% and 5% in full-year headline earnings per share. The group says this is as its new operating model is now in full force. More detail will be provided when the firm opens its books on the 4th of December. Tiger Brands also updated the market on the listeriosis class action. The firm says it is continuing with pretrial preparations, and once completed, a trial date will be allocated by the court. In the meantime, the company's attorneys are engaging with the plaintiff's attorney with a view to agreeing on relief to qualifying individuals who have urgent medical needs, even though liability is yet to be determined. Tiger Brands says it is committed to bringing the listeriosis class action to a close as speedily as possible. The saga has spanned 6 years after the National Institute of Communicable Diseases identified Tiger Brands as an enterprise foods factory in Polokwane in 2018 as the source of a listeriosis outbreak that killed 218 people and sickened more than 1,000 people. Lewis expects their interim earnings to be as much as 55% higher. That's after a strong trading and operational performance from its traditional retail brands. Best Home and Electric, Lewis and Bears benefited from continued strong credit sales. The firm will publish results on the 21st of November. Astral says it will be back in the black. The poultry producer expects to report full-year headline earnings per share of around 19 rand. That's after a loss of 13 Rand 24 per share a year ago. No reasons for the swing have been provided, but at the halfway stage, Astral did report higher sales volumes and improved sales from its poultry division. The company will open its books on the 18th of November. Further afield, the European Union has decided to increase tariffs on Chinese-built electric vehicles to as much as 45.3% at the end of its highest-profile investigation that has divided Europe and prompted retaliation from Beijing. Here's more detail in this package report.
In a move sure to rile Beijing, the EU plans to raise tariffs on Chinese-made electric cars. The new duties will range from 7.8% for Tesla to over 35% for state-backed firm SAIC. That's on top of a standard 10% import levy. The extra tariffs were officially approved Tuesday and will take effect on Wednesday. The EU says the move is needed to counter China's unfair state support for its firms, including special loans and cheap materials. It says millions of extra Chinese EVs are likely headed to Europe otherwise, with the US and Canada having already imposed their own steep duties. The China Chamber of Commerce in the EU expressed deep disappointment over what it called an unfair measure and criticized slow progress on talks over the issue. Beijing has responded with investigations into EU brandy, dairy and pork, and has challenged the EU's actions at the World Trade Organization. European car makers are dealing with an influx of cheaper electric cars from China, which now hold 8% of the EU market, up from less than 1% in 2019. That could reach 15% by 2025, with prices for Chinese cars typically 20% lower than European-made vehicles. Some EU member states aren't happy with the EU move. Germany, the region's largest car maker, was among countries opposed, fearing its big auto exporters could face retaliation. The country's economy ministry has called for a diplomatic solution to reduce trade tensions and protect EU industry.
And Volkswagen reports its third-quarter operating profit plunge of 42%. Weak performance in the core passenger car unit and high costs, including 4 model revamps, hit the automaker. Now let's take a look at this report for more.
Volkswagen hit another bump in the road on Wednesday in what was already a difficult week. The German automaker said third-quarter operating profit was down 42%, its lowest level in 3 years. Earnings before interest and taxes hit just under $3.1 billion in the July to September period, largely in line with estimates. Its passenger car unit has struggled with high costs and weak demand in China. The operating return on sales in the core unit fell to 2% after 9 months. VW's finance head Arno Antlitz said it shows the urgent need for big cost reductions and efficiency gains. The update follows Monday's news about potential plant closures in Germany for the first time in its history. VW's Works Council said the auto giant plans to lay off tens of thousands of staff as part of its restructure. It also aims to shut 3 factories and cut salaries by a tenth. VW is locked in a battle with unions over the planned overhaul. A second round of talks with German union IG Metall is due to start later Wednesday. A number of factors have been blamed for the challenges facing the world's second biggest automaker. They include complex governance structures and misjudged investments in electric vehicles. VW has lost market share in China to local competitors offering cheaper models. Deliveries to the country fell by 15% in the third quarter. VW has also endured tough market conditions in Europe. The car market has shrunk there by about 2 million vehicles since the pandemic and led to about 500,000 fewer unit sales annually. VW cut its annual outlook twice during the quarter, and rivals BMW and Mercedes-Benz also reported difficulties. Company shares were up 2.4% in early trade, while the stock has lost about a fifth over the last year.